I was supposed to come and talk to you, I forgot when it was early in the summer, and I had to pull out at the last minute, so I apologise again for doing that, and thank you for the invitation to come back, even though I pulled out before. I think I'm going to talk about something slightly different to what I was originally going to talk about. Originally I was going to talk about general thoughts on the sound money debate, and now I want to talk about a specific proposal on banking reform. What I'll do is I'll talk a little bit about how banking reform is becoming increasingly popular. We're starting to see discussions of banking reform take place in more kind of mainstream places. I'll give some thoughts about narrow banking in particular, which has become a little bit more popular now. But then I'll present essentially the plan that I propose, and then talk about that in light of the recent Carswell bill, which I'm assuming most people are familiar with, but if not, I'll stop me, and if I need to provide more detail of that, I will do, and I'll talk about how what I'm talking about differs somewhat to that. So I'm assuming that most people were aware that recently Mervyn King made a speech in which he talked about narrow banking and expressed his support for narrow banking generally. He referred to the current banking system as possibly the worst of all possible banking systems, and that got a lot of headlines. It's important that we understand that Mervyn King generally is favourable towards narrow banking, and he's made similar speeches before he was Governor of the Bank of England and since. On October 31st, 2009, he made a speech where he advocated narrow banking explicitly. The Economist picked up on that and talked about some alternatives to narrow banking, things like mandating that banks had higher capital ratios, making sure that banks had living wills, making sure that banks had catastrophe insurance, creating higher fees for lender of last resort services, and windfall taxes on bank profits. And so this is the whole kind of debate. And I think the important thing here to realise is that this debate is moving away from monetary policy towards monetary regimes. And for me, this is fundamentally positive, because the biggest difficulty at the moment is to get trapped by this debate about what scale of quantitative easing we should have, for example, rather than have a debate about whether quantitative easing as a policy tool is appropriate. So we're starting to see this movement from policy towards regimes, and we're starting to see this in fairly high places, as I say, the Governor of the Bank of England included. One thing to realise, though, is that when Mervyn King talks about narrow banking, and he actually goes against things like fractional reserve banking, he's really trying to take the focus away from the things that he controls as Governor of the Bank of England. What's noticeably absent in his discussion about the problems inherent in the banking system are what most free market economists would identify as being the main problems. Things such as legal tender laws, such as the monopoly of base currency, the fact that there is a government-backed lender of last resort, the fact that we have deposit insurance, and bank regulation. I often point out when we talk about bank regulation, seems to be kind of the conventional wisdom that there was too little regulation. I don't think in this audience we would find anyone that would say that any industry has too little regulation. But what I often say to people that make that claim is list 3 other industries that are more heavily regulated than finance. And once we kind of talk about health and possibly education, I don't think there is any industries that's more regulated than the banking industry. But those points I've just read out were kind of noticeably absent from Mervyn King's list of things that are wrong with the banking system. And I think the reason for that is that they are the core of the current banking system. They're the core of the system that we have with a centralised Bank of England and a nationalised currency. Now, I believe that we actually kind of, as a free market movement generally, I believe that we missed what was a constitutional moment to get across banking reform proposals during the financial crisis. I think it did take a lot of people by surprise. And when it came to the actual policy debate about how to respond to that, there was a lack of plausible free market alternatives. The one that seems to be emerging, that many people within the free market and libertarian movement are latching onto, is the general idea of narrow banking. And this is why lots of people in the movement were very encouraged by Mervyn King's comments about it. Personally, I think that this is misleading.
Just define what narrow narrow banking?
Sure, yeah. So when we talk about narrow banking, what we're essentially talking about is the separation of deposit taking within a bank and financial intermediation. The simplistic way of viewing this is essentially saying that banking institutions are unable to finance speculation with deposits. So there needs to be a very, very clear ring fence of deposits within a bank and the intermediary activities that it does, the loans that it gives out, the kind of the relatively riskier activities. Now, my arguments against this, firstly, I'm not aware of any evidence that Glass-Steagall would have prevented the crisis. And Glass-Steagall is seen as the kind of the typical narrow banking act that separated investment banks from retail banks, that was repealed in the US prior to the crisis, and which many people are using as an example of why we need to go back to that sort of regime and find institutions similar to that. As I say, I'm not aware of any evidence that splitting these banks, the big investment banks, would have presented the crisis. I also think it's a fairly populist idea to dictate how banks should operate. So the narrow banking alternative suffers from what Hayek would refer to, I think, as the fatal conceit, which is people having a fairly clear idea about the type of activity you are trying to implement. So whereas narrow banking kind of sounds good in theory, and intuitively it kind of sounds nice to separate the risky activity from the safe activity, I think this is a kind of a dangerously populist notion. The main reason for this is I think it kind of hideously underestimates the notion of risk and misunderstands the concept of risk. And note that in this, the idea of risk and ignorance are very much tied together. Generally speaking, if there is risky activity, I think it's appropriate that we confront it. So I don't think it's appropriate to try and protect people from risk. I think that risk and ignorance generally are things that we need to confront and we need to deal with. Another reason why I think this is important is because when we try to reduce risk, what we tend to see is that it shifts to other places. So this is a sociological argument as much as an economic one. But whenever we see people that, or certainly whenever we see politicians that, and policymakers that deliberately try to reduce risk, I would posit that all we do is transfer risk to other places. And the problem with this is that often it transforms it to less transparent places, and it becomes less obvious. The other thing is that we can't design regulatory systems that cope with innovation. Almost by definition, if we could anticipate future innovation, then it ceases to become what we would call innovation. So the idea that we can create some kind of regulatory regime to cope with future innovation in the banking system is misguided. We simply don't know what's going to happen. Therefore, any attempt that we make to, for example, protect against risk and to bundle up risky activity and to make a definitive judgment about what constitutes risky activity and what doesn't, I think misunderstands the concept of financial innovation. So with that in mind, because I think that narrow banking, generally speaking, is too simplistic, the proposal that I would present and suggest is based mainly on the work of Kevin Dowd and also Richard Salzman. And what I've attempted to try to do is make it slightly more palatable. So when they've proposed it in the past, it's been in kind of pamphlet form, and I've tried to really kind of simplify it as a proposal that people can really latch onto. So what I do is essentially say, okay, the next time that we have a banking crisis, no, I'm not saying that this is something that should be adopted today. I'm saying this is something that should be adopted when we are in the eye of the storm and when the crisis is actually occurring. And the reason why I think it's worthwhile putting this together is because there will be another crisis, and we as a kind of community need to be better prepared for that and have options on the table that we can implement. And essentially, what the proposal does is it says that there's 3 phases to how we should respond to this crisis. The first phase is to make sure that and Kevin Dowd points out that this could be done possibly over a weekend. So this should be done over 2 days. In other words, a very, very quick timescale. Is to try and establish that all operating banks are solvent. Note that one of the problems that we face with the crisis that we've just been through, you would have thought that the primary aim of the response to that crisis would be to establish which banks are solvent and which banks aren't. By offering bank bailouts, by injecting liquidity, we are masking over this issue, and it's certainly clear that some banks are better positioned than others, but we still have, I think, no clearer idea about which banks are full of toxic debt now than we did when the crisis was occurring. So how do we ensure that all operating banks are solvent? Well, step one is to remove deposit insurance. This is probably the easiest way to establish whether or not a bank is solvent. If we say that banks will not be able to rely on government support to gain the public's confidence, then in order to gain the public's confidence, it has to rely on its own business model. So remove deposit insurance. Step two is for the Bank of England to close its discount window. So the Bank of England ceases to offer emergency support to banks. State that any company can freely enter the UK banking industry. I think this is a very important step because when the crisis hit, we knew that it was often foreign-based banks such as HSBC and possibly Santander that seem to be more robust than banks such as Royal Bank of Scotland. And so we want to make sure that other foreign banks are more able to deal within the UK market. A corollary of this, step four, is that banks should be able to merge and to consolidate as desired. One of the fears is that banks get too big, and this creates kind of microcosms or concentrations of risk. But if you look at the history of US banking, I think when US banks were able to open branches across different states, this demonstrates that that large scale in banking can spread risk and can serve customers better. So we'd suggest that we'd allow mergers and consolidation. And then step five, hopefully, basically these actions would then mean that some banks are unable to continue. So what do you do when any normal business has a faulty business model and is unable to operate in solvency? You essentially go through bankruptcy proceedings. So in order to take these bankruptcy proceedings on insolvent banks, I would suggest you would suspend withdrawals to prevent a run. So you would, again, this is why this has to be done very quickly, because you would suspend withdrawals. I think it is possible to make this more politically viable to ensure that deposits up to a certain amount are ring-fenced. So we went from £30,000 worth of deposits being backed by the state to £50,000, and I'll come back to this point later. But I think that this is an important way to make this viable. You'd then write down the bank's assets. You would perform a debt for equity swap on remaining deposits, and you would reopen the bank with an exemption on capital gains tax, so that the idea then is that the bank is now open as a going concern. There will be investors in the bank that have taken a large capital hit, but this is as it should be, because this is what would happen in any other industry that faces this type of problem. Note that these acts I don't think would create a crisis, because by definition you would want to implement this policy proposal when there is already a crisis undergoing. The second phase of the plan, I would suggest, should take place over a period of 2 weeks or so. And this is, so step one is to ensure all operating banks are solvent. Step two is to monitor the emergence of free banking. What institutions do you need in place to have free banking? I think you need to permanently freeze the monetary base. So whatever the money supply is, the base money supply, you would freeze it. You would then allow private banks to issue their own banknotes, which would probably originally start off as operating similar to commercial paper. It will be up to consumers to choose whether or not they hold those notes. I think it is important to mandate that banks allowed depositors to opt into a 100% reserve custodial account. And I think to make this viable, it is important to mandate that, so that banks do offer this to all customers. I think it's also important to mandate that banks would offer fractional reserve accounts and make public key information. For example, the reserve rates, the asset classes that the banks are using to back their deposits, the compensation that they would offer in the event of a suspending payment. These are all the types of mechanisms that free bankers tend to rely on to say, hey, fractional reserve accounting, fractional reserve banking isn't such a bad idea. But I think that in a transition policy, you would want to mandate that that is publicly available and that the general public are able to view it. I would also suggest that the government must sell off all of its gold reserves and therefore allow banks to issue notes that are backed by gold. I think it's important that you don't go back to a traditional gold standard, where you kind of lock in gold as being the base currency, so that banks can choose to back their notes with any commodity that they wish. As a part of this, government would need to rescind any taxes on the use of gold as a medium of exchange, so that it is operating freely. And then the final step in this part is to repeal legal tender laws, so that again people are able to choose which currencies they wish to accept as payment. That would take place over a kind of a moderate period of time. Finally, the third phase, which I would suggest takes place over 2 months, is to abolish central banking. If the previous steps have taken place, then I think you can then get the Bank of England to cease its open market operations, so that it no longer finances government debt, and that you ultimately privatise the Bank of England, so that it may well remain as a central clearinghouse, but it would be owned privately and subject to competition from entrepreneurs that may wish to replace it with an alternative clearinghouse. So that policy proposal is deliberately intended to take place over different time phases. Over 2 days, you're attempting to make sure that operating banks are solvent, and that the ones that are insolvent go through bankruptcy proceedings as quickly as possible. Over 2 weeks, you'll be allowing free banking to emerge, and over 2 months, you would put the nail in the coffin of central banking. Obviously, this sounds radical. Let me quote Hayek. 300 years ago, nobody would ever believed that government would ever give up its control over religion. Perhaps in 300 years we can see that government will be prepared to give up control over money. Now, as I said, there's a similar discussion, and there is a discussion at the moment about different monetary regimes. The Carswell bill is a bill that was presented under the 5-minute rule by Doug Carswell MP and supported by Steve Baker MP. For those of you that aren't familiar, the key aspect of that bill is to make custodial accounts very easy, so that the general public can put their money into a custodial account. Their main concern is essentially a narrow banking concern, in that banks at the moment are able to use people's current account deposits and to lend that out. Their concern is that if those loans go sour, and if everybody wants to remove their money from their current account at the same time, then, as we all know, this would lead to a bank run. What they want to do is to make it physically impossible to have a bank run by making sure that all demand deposit accounts are held 100% reserved in a vault. Now, the interesting part about that bill is that it also gives scope to fractional reserve banking. So it's not necessarily a 100% reserve banking proposal, and it's not really a fractional reserve banking proposal. It is a kind of a middle ground, which I think is important and useful. But the comments that I'd make are, firstly, one of the key arguments that supports their proposal is the fact that at the moment the general public don't understand the nature of banking. So to many people, they think there's an inherently kind of fraudulent nature involved in banking, because the claim is that the general public do think that their money is available on hand should they wish to withdraw it. The argument is that the general public don't realise that in actual fact, if everybody went to their bank to try and redeem their money, there wouldn't be enough to do that, and there would be a bank run. My concern with this is that I think public ignorance issues generally aren't sufficient for policy reform. There's a kind of a paternalistic instinct that I think comes out in the bill, which is essentially saying that because the public don't understand banking, we need to protect them from it. As I said before, I think if people don't understand something, you want to expose them to it even more, so that they do understand it, so they do have incentives to actually think about it and to wonder what's going on with their money. But on top of this, I don't think we need to worry about whether the public understand the banking industry, in the same way that if you're buying a car, for example, it's not important that customers understand how engines operate. The whole point is that car companies kind of choose, a mixture of engineering techniques, and then present all of that in one bundled package, and customers can choose whether or not they wish to purchase it. There is a danger that you become too prescriptive by mandating what type of car, what type of engine car companies need to place in. Similarly, there's a danger you become too prescriptive if you mandate the type of bank account that banks have to offer. So as I say, I don't think public ignorance is sufficient on these grounds, and I also don't think it's important that the public do understand how banking systems operate. What is important is that there's competition and that people are free to choose what types of account they wish to take. Now, the good thing about the bill is that there was part of the bill which talked about an end of deposit insurance, and I think this is where the focus really needs to come in, and I think this is where there is scope to latch on to the general kind of public debate and to possibly make free banking ideas more palatable. As I said before, it used to be the case that £30,000 worth of current account deposits were protected by the state. I still don't understand why that's not sufficient to avoid any bank runs, because I don't understand why anyone would have more than £30,000 sat in a current account. It's very easy to open a new current account, so even if you're the sort of person that wants to have lots of money in a current account, all you need to do is have two current accounts and split your money, and you're still covered. So it's not clear to me why that creates a problem, but during the banking crisis this was increased to £50,000. Now this was done as a temporary measure, so I think there's an opportunity here to have the public debate about the removal of these temporary measures that were adopted during the financial crisis. So I think that there is a general kind of public sentiment which is that there is too much life support for banks generally, and there's public support to take that away. I think that you could present these ideas in that context and say we are now removing the life support to the banks. We gave out these essential kind of bailouts to banks so that they could be reckless, and if there was a bank run, then taxpayers are going to bail them out. So we say we're going to remove that. The problem with that is that then this creates, because of the public ignorance concerns, this may create some kind of panic because the public are very scared that they're going to lose their savings. Well, here's the demand for a custodial account. So the biggest kind of debate between people that advocate 100% reserved accounts, i.e. bank accounts that are reserved, that have all of the deposits held in cash in reserve, and the biggest debate is that if you do that, you can't offer an interest rate on those deposits, because by definition all the bank is doing is providing a custodial service and a safekeeping service, so you'd actually have to pay them. So the idea is, where's the business model here? As long as you've got instant access accounts that are paying interest on reserves, there's no kind of business case to offer a custodial account. Well, now we do see a business case for a custodial account, because if we think that the public are going to be concerned about the removal of these of deposit insurance, then I think it's plausible that if there is any market demand for a custodial account, it will exist in this case. So I think it's important that you adopt them. Depending on the audience I'm talking to, I kind of change my position on this. Given the audience that I am talking to, I'm going to kind of try and be controversial. So I'll say that you could well mandate that banks offer these custodial accounts. So you could mandate that every bank in the UK offers a free custodial account, which they promise they will not lend out, and that the money will literally be sat on a vault, so that there's zero danger of a bank run. When you go to any bank account online at the moment, you've got kind of a list of options to open up new types of savings account and new types of term deposits and all these various things. It would be incredibly quick and easy just to have another button on that website that says open a free custodial account, and you can sit in your armchair and within 5 minutes put as much money as you want into this 100% safe custodial account. And you could also mandate that banks publicise their key data that they have on their fractional reserve accounts, so that people are free to choose, and they have the information that they need to choose whether or not they put their money in their custodial account and not earn a return, or whether they put their money in a typical current account. They accept that money's being lent out, and if everybody wants to take it back at the same time, it won't be there, but they realise that there's a low probability that will happen, and in the meantime they get an interest rate. The more I kind of think about this, the more I think, well, given that so many banks in the UK at the moment are kind of effectively owned by the taxpayer, you don't really need to mandate this, and you don't need to intervene in private banks, because all you can do is say that the government-run banks should offer this as a service, and then if there is an actual market demand for it, then that's just a source of competitive advantage for those banks. So given that kind of since I wrote this, so many banks are now government run. You don't necessarily have to mandate this and force private banks to do it. You could just say this is a policy that we think that the state-owned banks should offer as a way of moving us to a free banking environment. Okay, so just to summarise, I do think that the public debate at the moment is wide open, and there's a lot of public interest in understanding more about the banking system. The financial crisis was a fantastic opportunity to try and get some ideas across. There have been some people, and I'm kind of relatively young, so I kind of, that's my excuse for why I haven't been going on about this for 10, 20 years or so. But, there have been people that have been going on about this for 10, 20 years or so, and there's the literature, in Libertarian Alliance literature, that shows that people have been making these arguments, and there have been people warning against the problems within the banking system, and the kind of the 100% reserve and fractional reserve is this wonderful debate that we have back and forth. But the bottom line here is that everybody in the free market community generally agrees on the key sources of the problem. It's the central bank, it's the deposit insurance, it's the fact that we have a nationalised banking system with a monopoly issuer of currency. We would all recognise that if the banking system was any other market, take the shoe market. If the shoe market meant that there was a building on Threadneedle Street in London, and once a month 6 people would sit in a committee room and decide on the price of shoes, and spend half an hour and then go and have lunch, we would all kind of recognise that is liable to create problems in the coordination of the shoe market. I think the general public kind of understands enough about basic market theory to realise why that won't work. There is this kind of fundamental issue where it comes to money that people, I think, just automatically equate money with capitalism, and therefore assume that because we're talking about money, it's therefore necessarily kind of free market or something. As soon as you point out to people that the money is controlled by a nationalised central bank, it's a central planning agency, it's a Soviet-style planning board, then I think people kind of latch onto that, and I think that there's that people are increasingly thinking of it now. So this has been a vindication for those of, not necessarily myself, but those people within this general community that have been warning against these problems in the banking industry for a long time. I do think that we missed the opportunity to really get some reform proposals out there and to get the general public to understand what the solutions are. But the increasing way in which we're kind of muddling through at the moment and not solving the root cause of the problem means I think we are destined to repeat it. And I just hope that when that time comes again, there are more kind of plausible policy reforms that we can propose and that we can actually adopt, and hopefully take the state out of money, and in doing so have a free market of money. Okay.
Thank you very much indeed.
I think I agree with almost every one of your proposals in terms of what needs to be done to get us to a free banking system. I think you said the removal of government support for the banks, the removal of regulation, allowing insolvency, eliminating central banking, and ultimately getting a free banking system. All those are plainly desirable. What I find curious, I think I completely disagree with you, is the suggestion that we can leave all those proposals until the weekend of the crisis. Because if we leave all those proposals until the weekend of the crisis, nobody will listen to us. I would have thought that what we have to do is to be working on the arguments many, many years as hard as we can, so that when the crisis comes, we are able to say, this is what we've been saying for a very, very long time, and hopefully by then people will be listening. If they haven't been listening, then they will listen. But just to turn around on the Friday and say, here's all our schemes, I don't think people will listen. And indeed, I mean, the fact is, I've made a point.
Yeah, no, I think I agree with you. This isn't something that I think I'm suggesting we kind of just put in a drawer and then kind of bring out when that happens. yes, we constantly need to be making the case for liberty in every market. We constantly need to be chipping away at the integrity of the Bank of England. We need to be pointing out the mistakes that they're making, and we need to build that climate of opinion so that free market ideas become more plausible. The kind of my motivation for doing this, though, was that I think that we can kind of underestimate the extent to which there was chaos and genuine panic amongst central bankers during that kind of relatively short period of time, where they were groping around for ideas. QE kind of came out of, I wouldn't say nowhere, but this was an incredibly radical policy that was kind of latched onto because we're in a crisis and we've got no ideas and what can we do. And I'd like to be able to kind of in that position. I wouldn't be in a position to do that, but I'd like to think that the next time that happens and people are just trying to find things that they can latch onto, that some of these ideas will be available and possibly dismissed, but at least available. That was kind of the eye of the storm type proposal. The Carswell bill is what we do from now, which I think is the more appropriate question. And what we do from now does rely on, a general kind of campaign in terms of educating the public, educating politicians, and building a proper campaign. So I would kind of differ the order to some. So some of these ideas I'm making are kind of time dependent, and the key thing is the solvency issue. I differ the order in that if we are going to say what should we do from today, then I think removing kind of deposit insurance immediately isn't the best thing to do from today. If we're going to do a kind of a more gradual reform and try and build up consensus, then what we'd want to do is to kind of make sure that these custodial accounts are in place and then withdraw the deposit account.
And I have one response to that. I would have thought that that's the worst possible thing to do. If we want to make sure that insolvent banks are demonstrably insolvent and are allowed to go bust, surely we need to be getting rid of the support structures now in anticipation of what will happen and to be arguing for that. To turn around at the weekend and say, right, well, we're worried about the solvency of lots of banks, so let's make damn sure that they all go insolvent by taking away deposit insurance and take away the supporters. You'd have your head torn off unless you laid the ground in advance. But if you laid the ground in advance, then you won't need to be doing it then because it would already have been done before.
Yeah.
So in a sense, either we've won the debate before we get to the crisis, or I'm afraid to put forward the proposal having not previously won the debate on the Friday. I just can't see that working. So where I'm getting to is I sort of feel that having detailed proposals for what to do on Friday, Saturday and Sunday is a bit of an intellectual waste of time. I don't mean to decry what you're doing, but I think it's far more important to lay out the arguments now, and as part of that, say actually this crisis is not over. So I mean that's the way that. Yeah.
I mean, so they're two different questions, right? So the question is the next time everything implodes, what should we do? And it's
what we've been saying that we should have been doing for 30 years.
Right, but then the point is in terms of the actual kind of ordering of what you're doing, I think would kind of differ. You can't. You need to. I think you do need to have a separate implementation strategy and general kind of proposal. So the question I'm trying to answer is when you have the crisis and things are imploding, what should you do? And this is an incredibly historical thing. Exercise that I'm engaged in, and then it's a different question about from today what should we do to try and make sure that we have an environment more conducive to some of these ideas. So I applaud kind of what Doug Carswell and Steve Baker are doing, because they're saying, okay, from now going forward, how are we going to try and make this more likely? Possibly. But it was very much the kind of the proposal that I wanted to do was say, okay, that we need people doing that, and we need to have a big debate about what we should do going forward. But having said that, there's also a downside risk to that, which is that as soon as we start talking about some of these issues, they become untenable because we may not win those arguments. And my background is doing research on radical policy in Eastern Europe, and what you can find there is that often cases the countries that had the least public discussion of policies were the ones most likely to adopt radical reforms, because when the crisis hit, there was a void, and so people kind of latched onto coherent plans that fitted, yes, with their kind of possible ideological priors, but because these ideas are radical. If you float them and have a big public debate, that's something I would encourage. But I would strongly suggest, or I'd be concerned that if you did have a big public debate about eradicating deposit insurance and abolishing the Bank of England, then they would almost become untenable, and you'd weaken the possibility that you could implement them in a crisis.
Us to keep quiet.
I wouldn't encourage us to keep quiet, but I'd certainly say that.
You must follow that. From what we just said.
Yes.
I think it should be a consideration. I think that I wouldn't follow it, but I think that you can always look back and say this is the conspiracy theory, right? That we have all these ideas, and then in a crisis, the politicians kind of meet their kind of underground folks that gives them the plans and they adopt them and everything. I don't think that holds empirically, but I think that we'd be more likely to adopt radical policy if that was true.
Perhaps that's why we've been unsuccessful. We've been talking too much.
Christian? I'm not sure actually that politicians would adopt this kind of policies in a crisis unless the state itself was broke. Because I don't see a politician in time of crisis saying we are not going to act and we are going to let the market act. Mm-hmm. That is not what politicians do. I mean, because that would like shooting themselves in both feet.
Yeah.
So, on the other hand, I think that insurance, deposit insurance, is a good thing, and not necessarily. The problem is not deposit insurance. The problem is that it is provided by the state. But I think that you could have a market for deposit insurance,
yeah.
and the premiums would be more or less linked, I would say, with competition and so on,
yep.
to the rate you would charge for 100% custody.
Mm-hmm.
So either people could say, well, either I'm paying my bank, whatever it is, 0.5% a year, for custody, or I'm paying an insurance company for 0.5% or whatever it is,
yep.
to give me insurance
yep.
up to whatever
yep.
it is.
Yeah, yeah.
And so that would be the trade-off. And
yep.
then I'm getting, 2% or something
yep.
like that, interest on my deposit.
Yeah, no, I think that's a good point. I think that it's kind of, I should make it more explicit, but it's implicit in my argument that when I use deposit insurance, I am specifically talking about taxpayer subsidised deposit insurance. So yes, private deposit. I don't know. Private deposit insurance. I think is probably an innovative a good financial innovation. And you're quite right that might therefore make it more likely if that you don't necessarily need to have a strictly 100% reserved account if you've got deposit insurance. The interesting question then is that one of the common arguments against fractional reserve banks is that in order to have a fractionally reserved bank, you need to essentially be exempt from normal business law because you're not keeping your creditors whole, and that the banking industry have these kind of curious ways in which they can get around auditing requirements that any other business can't do. But then when you have the debate between, so when you use insurance company examples of how they don't necessarily keep their current creditors whole because they're still taking a position that subsequent events might mean they get wiped out and they're not fully backed for that. So they're taking this risk position. The argument tends to be, well, insurance companies are always, by definition, 100% whole and keep their creditors whole, but banks don't. So the interesting thing for me is if you have private deposit insurance, and you have an insurance company that's insuring the fractional reserve funds, then it kind of, to me, it blows up the argument about 100% reserve banks being a necessity. So no, I would encourage that, and I think another avenue is to possibly, and this is a gradual policy idea, is to say let's try and create some kind of private deposit insurance program. I mean, there are private deposit insurance programs because deposit insurance existed before it was taxpayer funded, right? And so when I looked at when I was looking at Lloyd's TSB accounts, and it said their deposit insurance is through I forget the name of the particular financial services organisation, but that is an industry funded organisation, and to be sure it's heavily regulated, but it's not necessarily taxpayer funded. I don't know the specific accounts at which that is applicable and which ones it isn't. But I think there's a fairly easy step to move from that. So you're quite right. One possible way of doing that now, something that we could all be working on, is to try and make sure that private deposit insurance is seen as a more viable alternative, so that we don't just withdraw insurance immediately and have to wait for that to emerge spontaneously and privately. So yeah, that's a very good point.
For the lady, then you.
You said that your talk was from the work of Professor Kevin Dunn. I seem to remember that he made some proposal to recapitalize the banks that were going bankrupt. Could you explain this a bit?
I'm not sure what you're referring to. I mean, in his plan, he's talking about about in the same way that if a normal company is going bankrupt, then it doesn't necessarily mean that it dies and everybody loses all of their money. You may find a way to recapitalise it into some people, some shareholders are going to take a loss, but you can find a way to recapitalise it. And I think that's what he's talking about.
To recapitalise the banks.
Okay, I mean, for me, I think that we need to be thinking seriously about how to recapitalise the banks, and our present way of doing that is through bailouts, right? So we use tax-funded money to bail out banks as our way of recapitalising them, or we use quantitative easing, which is essentially a free lunch for the banks to repair their balance sheet without actually doing anything to help the wider economy. Personally, I think that the alternative way to recapitalise banks is through deposits, right? So how do we want, if we want banks to be able to lend more money to businesses, then you want them to be able to take more money in as deposits, and the only way to do that is for interest rates to go up. So I think interest rates do need to go up, and if they do, then you're going to get increased deposits, which are then a form of recapitalisation. But recapitalise based on voluntary savings, not based on taxpayer bailouts.
I wondered if banks did have to offer sort of 100% deposit accounts. What percentage of people could do that before they would basically have no money? Because they obviously don't have all the money that is held on deposit at the moment. Mm-hmm. Wouldn't it only take quite a small number of people to opt for that?
Yeah.
100%.
So in terms of actual kind of reform proposals to seriously implement it, Jesus Huerta de Soto basically advocates that you print the cash required in order to be able to do that. So what you do is you essentially replace electronic demand deposits with the cash value with that. And he would argue that's not inflationary, because you're replacing one component of the money supply with another component of the money supply. But you would need to have the central bank print that so that you can have that. So I think that it's a well taken point. But then I think that's how they would respond to it.
Just on the following one.
Yeah.
I mean, how much attention do you pay to what goes on in America? Because whereas in this country, I've never seen anybody with a placard saying "End the Bank of England." I've seen plenty of people in America. So do you think that there is hope that we will learn something from our cousins on the other side of the Atlantic?
So I'm an Austrian school economist, and I think that the financial crisis is the second revival in Austrian economics, and this is a real, we're going to increasingly see Austrian ideas kind of take over. And if you look at the US, it was the financial crisis that meant that Ron Paul in particular and Peter Schiff, their reputations, just exponentially increased. And we don't have the same figures in the UK. And they are the focal points of those movements. I think that someone like Steve Baker, I don't think he differs a great deal in terms of ideas to someone like Ron Paul. He doesn't quite have the public awareness that Ron Paul does. But we're kind of getting there, because 2 years ago I don't think there was a single politician that would openly propose that we abolish the Bank of England, and I think kind of Steve makes those sorts of noises, so that I think that's a really encouraging sign. But I guess it feeds into a kind of a broader kind of cultural issue, right? We don't really have a Tea Party movement. in the UK in the same way that they do in the US. We had a kind of, British people are prone to, campaign against taxes. I'm thinking of the poll tax in particular, right? So that, we do, it's not like we just kind of sit there and take it on the chin and everything. We can get worked up about stuff. But we don't really have a Tea Party equivalent. We don't really have an End the Fed equivalent. I think it's possibly cultural reasons for that, but I think it's a shame. I think that I think it would be good if we could galvanise a bit of support for that, and it become a lot more commonplace for people to be part of an honest money or a sound money movement, and to have that as End the Fed is a nice slogan. End the Bank of England isn't quite. No, we need to think of a slogan, a catchphrase or something.
Oliver?
I'm sorry.
Anthony, you said you've given this talk to a number of different groups. I just wondered what kind of response you can feedback you've got from different groups. Detlef Schlechter gave a talk last month along the same lines, and he's worked in the city for almost 20 years, and he says that people in the city just don't get Austrian economics, or very, very few do. So what chance have we got to explain Austrian economics to politicians or let alone the public? In America, as my friend behind said, that you do get there is a strong anarchist movement over there, and they start the agorism movement trading in silver themselves, saying that we're not going to go political route, we're going to do this. So there is a strong movement over there. What feedback have you got on your ideas from this?
So I think there's two different kind of things here. There's the general kind of Austrian school economics, and then there's the kind of specific proposal. And again, this is a vanity exercise in that I'm not I present this as a way to try and prompt debate and get people to think about how we might move to a free banking environment. But really this is a vanity exercise in that the next time there's a financial crisis, I want to be able to sit back smugly and think, well, if they'd listened to me, they could have listened to me, but they chose not to. And that's basically my motivation for doing that, is just to be able to smugly say that, and feel as though that there was an option to listen to me, but they chose not to. I don't have any expectation that anyone will listen to me, but just to make sure that they're doing that. That they can't come back and say, well, what was your idea? You didn't have anything. You didn't have a proposal yourself. In terms of the general Austrian movement, I think there's a lot of latent Austrianism in the city. So I have a presentation which is I take a Mark Skousen pamphlet which he wrote in 1988, which is essentially the stylised facts of an Austrian boom bust cycle, and it's kind of bullet point what you'd expect to see at each phase of the cycle, and I just go through that, and I've got charts showing whichever market it is at each phase. So when it says that at the boom phase, producer prices will rise faster than consumer prices. So I just show a chart showing producer price index, consumer price index at that time period. There will be a stock market boom, show the FTSE 100. Interest rates will spike upwards, LIBOR, and I just do, I go, for me it's incredibly compelling, and I think we've just experienced an Austrian boom. And when I presented that to a few different audiences, and there's some people that I think are self-taught, and they understand the Austrian business cycle theory. They understand the problems in the banking system. They're too busy making money to, give talks about it and to write books about it and do other things like that. There's also some who are kind of familiar with it, and then this experience has made them really think about it, because they kind of Steve Baker is one. If you ask Steve about how he got into Austrian economics, he was familiar with it. He saw the dot-com boom and thought, this kind of fits in with an Austrian type theory. And then he says he kind of forgot about it because he assumed that, everyone else was onto that and would be aware of it, and that, we'd learn from that and not do the same mistake again. And then he saw the housing boom and thought, hang on a minute, this is the exact same thing going on again. And that's what kind of convinced him that he needed to do something about it, and to really kind of to look at it. And I think there's a lot of people like him who were kind of broadly familiar with the Austrian story, probably downplayed it a bit much, possibly got kind of sucked into the great moderation theory and thought that everything was fine, and the general exuberance of that time, and now kind of sit back and say I should have given that a lot more attention, and so there is a lot of latent Austrianism that I think out there, and these ideas I think are going to become increasingly prominent. In terms of like kind of strategy, you know, I think you want to engage on as many fronts as possible. So anyone that's willing to listen, whether it's politicians, if they're willing to listen, I think we talk to them. If they're not, then we don't. You know, we concentrate efforts elsewhere. So you can kind of buy and sell silver and stuff, but then, you know, I think the funds that have been making the most money recently, you know, if you look at what they've been investing in, that's perfectly consistent with an Austrian story. And I actually believe that a lot of them do that explicitly. So I think, you know, a lot of them read Austrian books and use that. I've got a working paper which is about who kind of predicted the crisis, and I think some people did predict the crisis. And you know, the evidence that I've found is that, funnily enough, it's the same people that predicted the .com boom, and you know, they come from a relatively Austrian background.
Right.
David first, then Gavin, then David.
Of course, the one thing which you missed out from your talk, which it might be said is the single most important thing that we can be heard to say, is that if we're right, then the crisis is not over.
Hence, let's get.
Some of what you said sort of sounded as though, well, the crisis is over and now we're going to wait for the next one in 8 years' time. You know, but if we are right, then what's been done over the last 2 years in response to 2008 is the worst possible thing to do. And is going to make the next crisis even worse than this one, and probably the gap between the crises will come down as well.
I think that generally speaking, the crisis, you never have separate crises, right? So I think there's an incredibly powerful narrative which is not a distinctly Austrian story. I think this is mainstream economics and accepted by the best economy, you know, the most famous mainstream economists. Is that you've got the .com. You got the .com boom. Before that, you had, you know, Russia and things like that, and you know, you've got capital. The metaphor I use is an airbed analogy. So you pump the airbed full of air, it creates a bubble. You know, when that bubble bursts, it never does burst. Truly, all that happens is that it kind of spreads somewhere else. So we had the .com boom, and then rather than let that burst, we created a housing boom. And then now, rather than that burst, we're now having an emerging markets boom, or possibly a gilts boom, or, you know, some other boom somewhere else that we still haven't identified yet. So we're constantly lurching from one crisis to another. But having said that, I would say that rather than, I still think we are in the same crisis now. We haven't had a crisis, and now we're going to, at some future point, have another crisis. I think historically we will look back on today and view it as, you know, and this is a point I've made a number of occasions, if things now feel as though they've calmed down a little bit, it's more likely to be the eye of the storm rather than the storm has passed. So I think it's very important that all Austrian school economists and free market economists generally, whether you're economist or not, are positioning themselves such that we can say, I told you so, and this is more evidence for why you should have listened to us.
If we're right.
If we're right. This is Steve Baker says what we, what should I, how, as a coalition government, what should we, say if there's a double dip, if there's a double dip recession, then, how can we kind of get over that? Because the public are going to quite rightly, be up in arms and everything. I said that, I think the best thing to do is to assume that's going to be the case, and therefore not be too triumphalist about the recovery that we seem to be experiencing at the moment. Don't get carried away, because whatever we say now about growth prospects, I think, can very easily come back to harm us.
Gavin?
What I was going to say is that we've been members of the European Union for quite a long time now, and they do a lot of other nonsense, small petty things and all that stuff. But ideally, they should have taken sole responsibility for all the European Union countries to how to control banking and things like that. They should have taken much more responsibility. But they reliege on their responsibility. So, to my mind, we are coming to a time when Britain now has to decide whether, given all the things, the pros and cons, they have to decide whether it's really worth staying within the European Union or come out altogether I'm trying to form a group of people, Eurosceptics,
Yeah.
to come out all together and renegotiate the trade agreement. Ideally, we don't need the European Union because we're members of the G8 and we get all the facilities from the G8. So I'm going to make very strong this in the New Year's. I'll spend the whole year devoting time to writing to all the Eurosceptic MPs and other important people to come out once and for all from the European Union.
I mean, I think it raises the issue about kind of governance and the level at which you should have governance. So in the banking industry, I think that you could. I think that it's theoretically possible that the EU could be used as a way of improving the banking system across Europe.
Should have done it a long time ago.
But I think that if you put your hopes in higher level governance institutions, then all you're doing is increasing the risks of getting that wrong and having greater effects. So I'd rather that we had more localized experimentation in banking systems, and that we had more different banking systems. And some banking systems that can fail, and we can learn the lessons from that, rather than try and kind of coordinate and have a one size fits all. That's the problem with the EU, is that the whole point of the EU is that it's one size fits all.
Yes,
we know that we will have different
if
kind of.
Australia and New Zealand can have such efficiency in their banking system, I don't see why we, a much bigger country economically, or even Germany has got very efficient ideas, right? And this, but even their hands are tied up, you see.
Yeah. No, I mean, we're certainly learning a lot about EU from the crisis. And again, talking about eye of the storm, the situation with Greece, I think, is again that's about to come back and by we've not put that behind us.
We talk about fractional reserve banking, and very often one of the objections to have no fractional reserve banking is that there will be no credits. And indeed, if we impose 100% reserve, for a while there will be no more credit, which is going to make the economy really bad. What do you say to that?
So some of the proposals for 100% reserve banking are attempting to kind of freeze the current money supply so that you don't see a massive decline in monetary contraction. I think that certainly fractional reserve banking increases credit over and above what the amount of credit that would exist in a 100% reserve system. Now the issue with that is, I think we all know that the amount of credit and the overall money supply doesn't determine economic activity in the long run. It doesn't really matter what the money supply is. What really matters, what I'm more interested in, is how it changes and how the effects of it affects the real economy. But at the end of the day, it doesn't matter whether or not the money supply is £50 trillion or £5 trillion. It makes no difference.
Quite right, but when you stop them,
there's
a change.
Yeah. So I think the issue here is, which is a slightly more kind of technical debate, which is how we define inflation, because people that tend to favour fractional reserves would define inflation as being when the demand for money, when the supply of money exceeds the demand for money, and it's only in that condition when you start to see excess credit creation and the kind of the boom bust cycle take place. 100% reservists tend to define inflation as just the money supply. So I think that you've got kind of the fractional reserve argument is that the money supply will expand not as much as it would under a fiat fractional reserve system, but more so than it would under a 100% reserve system. And I think it's a serious consideration that there would be less credit available. I think we need to have less credit available because the whole problem in the financial crisis was there was too much credit available. So we need to have the economy would be better managed, and it would run more smoothly if there was if there was less credit available and it was more difficult to borrow money.
Yes, but that's when it's stabilised. But for banks to increase their reserve, there will be a period during which there is no credit at all, because they need to increase their reserves, and during that period, you may create a huge crisis.
Yeah, but again, as the point I made earlier, I think that many of those proposals would print the cash to match the current demand deposits, so that you'd replace certain types of money with other types of money, so that you wouldn't necessarily have that immediate contraction as you implement the 100% reserve system. So I think they take that seriously, and they try and have a mechanism by which you wouldn't see a massive overnight decline in credit. There are some people that advocate 100% reserve arguments that say we want a big monetary contraction because we've got all of this additional, we've got all of this bad investment and we want to liquidate it. So it's a good thing to have a big deflation and clear everything out and have another kind of Great Depression so that we can then start from scratch again. You have other people that say, well, that's not necessary. We can freeze the money supply now and just have 100% reserves going forward. And then you have other fractional reserve people that will say freeze the money supply, but then allow private banks to extend credit as they think it matches with the demand for money. But certainly, any kind of free market system there would be less credit available, and it would be harder to get credit than currently, and that's a real challenge that we have. Because it's politically popular to have low interest rates and to be able to borrow money easily. The problem is people don't understand that the cost of that is periodic crises. So yeah,
David?
It seems churlish to criticise people like Stephen Baker and Douglas Carswell and their ilk, because after all it's very nice to see Conservative MPs who are Libertarian inclined. But I have real problems with the Carswell bill. I mean, obviously it's not going to become law, it's a 5-minute rule bill, it's a piece of propaganda. What concerns me is that it's actually not a bad piece of propaganda, because I think it hits all of the cranky buttons. One of the problems that I have always had with part of the Austrian school is the obsession with the fractional reserve banking debate. And some of the arguments are just wrong. I mean, the argument that it's unlawful, that it's fraud, all that kind of just nonsense. And anybody who knows anything about law will know that it's nonsense. And yet what we see with the Carswell bill is an overwhelming focus on precisely that. So we get a focus on what is not, I think, the real problem, because the problem is not fractional reserve banking, the problem is government support for banks that enables reserve ratios that would exceed those that would exist on a free market, and therefore more credit than would exist on a free market. That's the problem. It's not fractional reserve banking as such, which would always exist on a free market to some extent. The second problem is I think you identified this, and I think at one point you criticised it, but then at another point you actually endorsed it, is the notion of mandating banks to create certain kinds of accounts and not have other kinds of banks, and not have other kinds of accounts, and provide information, etc., etc., etc. And I'm against that as well, because I think that sets a very bad example of the idea of mandate. Even allowing for the fact that these banks are really semi-state entities anyway, even allowing for that, I think it sets a bad example. And the third point is that it's just absurd nonsense anyway, because nobody in their right mind is going to well, I say very few people. If you want to put your cash into a bank and keep it safe, the facility already exists. It's called a safety deposit box. It's there already. So the idea that you have to mandate these accounts, which nobody will use, because if you've got a choice between 3.5% on deposit or minus 0.5% on a deposit, 100% fractional reserve, very, very few people, except maybe for overnight, might go down that route anyway. So I've got real problems with it. But my real concern is the first one. I just think it sounds cranky. I think it doesn't really focus on what the real problems are, which is state support for the banks, excess regulation, barriers to entry, etc.
The problem is that it's an issue that divides the Austrian school and libertarian thought on this. My approach is that I think that there's a possibility that you can find a proposal that both sides could buy into, and that will increase the chances of it gaining legitimacy. So it doesn't really matter what side you kind of fall on. I think you, to me, it's about finding that kind of the common ground that kind of, and this is why I kind of say, that's why I have the mandated bits, which isn't in Kevin's plan, but that's my attempts to try and get those guys on board.
For example, a bill to abolish the Bank of England, that would strike at the heart of it. Again, it won't pass. But if you want to get a propaganda message, it's a lot more effective than piddling around.
Yeah, no, I mean, I was disappointed that the outcome of that bill was. It certainly seemed that they were going against fractional reserve lending. I think that I don't think that was necessarily the main intention. I think they would argue that was one kind of component of it, and certainly the critique that I made was the kind of the paternalism aspect, and I think that's what they've kind of possibly latched onto a little bit, which is that we're trying to protect people, and custodial accounts and things like that are essentially a form of consumer protection. I think they view it I think Doug Carswell in particular views it as a consumer protection bill. Now it's going for a second reading. I'm hopeful that it will be a bit more kind of balanced in that regard, and that it might be a little bit more kind of, I think it's too much in the 100% reserve group, and it might move back so that it can kind of mediate a little bit better. But no, I mean, I agree with you that I was disappointed that it seemed to be going after the wrong thing, and that it needs to go after, to me, deposit insurance is the way into it, and is the way to strike the debate. But then they're taking it seriously, so that the end point. I think as well is that they are thinking in terms of transition process and what's most likely to kind of. There is an issue about feasibility, and we could say, well, the whole thing's completely unfeasible anyway, so we may as well just be controversial. But I think they are thinking about feasibility as being an issue, and then a kind of step-by-step process, which I think in their view would possibly end up in a fairly similar place to where I think we'd want to end up. But I think they have a different route there, and Fortunately, that is the job of the politician, right? It's for the kind of the economists and the academics and the philosophers to say, this is what we want, and then it's up to those guys to kind of manage the interest groups and create the rhetoric by which we can get there. So we'll see.
Is there any other speaker? My goodness, you've reduced them to silence. Thank you very much indeed, Anthony.
Pleasure, thank you.